Welcome to the Deep Dive.
Great to be here.
Today, we're digging into the first quarter results conference call for BRP Inc. That's for their fiscal year 26.
Right, BRP, the company behind brands like Ski-Doo, Sea-Doo, Can-Am.
Exactly. And the idea here is to get beyond just the press release numbers. We're pulling out what management themselves highlighted from their call.
Yeah, understanding their perspective, what they see as key drivers, and where they're focusing their attention right now, it gives you a much richer picture.
Okay, so let's jump right in. What were the top line numbers for BRP's first quarter?
So for Q1 Fiscal 26, they reported revenue of $1.8 billion.
$1.8 billion.
Okay.
And profitability?
Normalized EBITDA, that came in at $201 million.
Right.
And that translated to normalized earnings per share of 0.47 cents.
47 cents. And how did that measure up? Did they meet their goals?
That's the key point, really. Management said overall performance was sound, and importantly, it was right in line with their own expectations going into the quarter.
So they kind of saw this coming.
Seems like it. And they also pointed to strong free cash flow generation, that's cash after operations and investments, $162 million there.
Okay, meeting expectations sounds pretty good in what they described as a tough environment, right?
Absolutely. They were very upfront about that. They talked about a challenging operating environment, significant macroeconomic uncertainty still.
And tariffs, too, that came up.
Yes, a volatile tariff situation.
Yeah.
Both of those things really weighing on consumer confidence, making people maybe a bit hesitant.
Makes sense. So against that backdrop, what do they say their number one priority is?
The main focus, and it came up again and again, is right-sizing network inventory. That's the product sitting at dealers.
Getting those levels down.
Exactly. Especially for seasonal products, after a couple of weaker seasons. Beyond that, just focusing on executing the things they can control internally.
Okay, so even though they hit their internal numbers, the market's still tricky. Let's talk about what customers were actually doing. What did they say about retail trends?
Globally, it's a continuation of a trend we've seen. Demand is still stronger for the high-end stuff compared to the entry-level products.
Right. People with more money are still spending, maybe.
Seems that way. The economic pressure looks like it's hitting those potential entry-level buyers more directly.
And how did BRP's own sales stack up against the industry within that?
This was interesting. There was a bit of nuance. They said they actually outperformed the industry when selling current unit inventory.
So the brand new model?
Yeah, the latest model year stuff. But they underperformed when it came to selling non-current units, the older model year inventory.
Huh. Why the split? Why sell less of the older stuff than competitors?
Their explanation was pretty direct.
Yeah?
They just have less of it. Their overall inventory position is leaner.
Ah, okay.
So while maybe some competitors had more older stock they needed to push out with discounts, BRP simply didn't have as much excess inventory to move.
Got it. So maybe less discounting pressure needed on old stock, but winning with the new. Let's zoom into North America then. How did retail look there overall?
For BRP as a whole in North America, powersport retail was pretty steady. They said they slightly outperformed the overall industry, which they pegged as being down low single digits.
Okay, slightly better than the market, but wasn't that North American number kind of hiding a big difference within the region?
Absolutely, yeah. A big split. The overall performance was really boosted by huge growth in Canada, up 21%.
21% in Canada. Why so strong?
That was almost entirely down to a strong late end to the snowmobile season. Good snow conditions late in winter allowed them to really move snowmobiles that had been sitting.
Finally caught a break with the weather there.
Exactly. But that Canadian strength was offset by a 6% decline in the United States market.
So Canada's winter helped paper over some U.S. softness. What about outside North America, international?
International demand was generally softer. Retail is down 22% in the EMEA region, Europe, Middle East, Africa.
Wow, 22.
Yeah. And down 13% in Asia Pacific.
Any bright spots internationally?
Yes. Latin America stood out. Retail there was actually up 18%.
18%? That's strong. What drove that?
They pointed to sustained momentum, particularly in off-road vehicles, or Can-Am side-by-sides and ATVs, and also personal watercraft, the Sea-Doos.
Okay, let's get into the specific product lines then. Where was the strength and weakness looking at both, retail sales and the revenue they actually booked?
Well, on the retail side, the absolute star was snowmobiles in North America. Retail sales were up over 80%.
80%, just from that late snow.
Largely, yes. Those favorable late winter conditions just extended the selling season, let them clear out a lot of units, and really catch up on their seasonal plan. They emphasize they're still #1 worldwide with Sea-Doo and Lynx.
Okay, 80% is huge, even if it's weather-related. What products saw retail declines?
Three-wheel vehicles, so the Spyders and Rikers, plus personal watercraft and their switch pontoon boats. They all saw retail declines early in their respective selling seasons.
Why was that?
It reflects, softer industry trends overall as we headed into spring, but also just the impact of a late spring in many key areas. People weren't rushing out to buy boats and bikes.
Right, the weather factor again. How did all this translate into booked revenue for BRP?
Okay, so year-round products revenue, that's the Can-Am side-by-sides. ATVs, three-wheelers, that was down 4% overall to $1.1 billion.
And the reason for that dip?
Management said mainly those softer retail trends we just talked about, and also needing to use higher sales programs, incentives or discounts to keep things moving.
Within that year-round category, Can-Am side-by-side retail was down about 10%, right? Which was a bit worse than the industry decline.
Correct. Industry down mid-single digits, BRP down about 10%. But again, they linked that underperformance specifically to the non-current units.
Because they had less old inventory to sell off.
Exactly. Competitors were likely pushing older models harder, whereas BRP had less to push.
But didn't they say they gained share on the new side-by-sides?
Yes, and this is the key part. While total retail was down, they gained 4 points of market share, specifically in the current model year side-by-side segment.
So the new stuff is selling well relative to competitors.
Suggests good reception for their latest models, yeah, and good execution by dealers selling what's fresh.
Okay. What about ATVs?
ATV retail was down low single digits. That was actually right in line with the overall industry trend.
So holding their own there.
Pretty much.
Yeah.
And they actually saw strong performance and share gains in the high CC segment, the bigger engine ATVs. They specifically called out the positive impact of their new Outlander platform there.
And the three-wheelers. Spyders and Rikers. You said retail was down sharply.
Yeah, retail down significantly in the high 20% range early in the season. Again, reflecting that general industry softness and the late start to spring riding season.
Any news on their new electric motorcycles, the Can-Am Pulse and Origin?
Yes, they mentioned initial shipments of both models started in Q1. That's to dealers in North America and Europe. And those shipments are continuing now in Q2.
Okay. Now, shifting to seasonal products, revenue there was down much more, right? Down 22%.
Yes, down 22% to $419 million. And, in a way, that bigger drop is kind of what management wanted to see.
How so? Less revenue is good.
It directly reflects their strategy.
Yeah.
They deliberately shipped significantly fewer seasonal units to dealers precisely because they're trying to right-size that inventory.
Ah, okay. It's about controlling the wholesale shipments.
Exactly. Within that, PWC retail, the Sea-Doos, was down mid-single digits, which they said was actually in line with their internal expectations for the quarter. And switch pontoons were down in the low 20s.
But PWC was doing well in Latin America, you mentioned.
Correct. PWC saw mid-single-digit retail growth in Latin America, helping that region's performance. But globally, the main objective for PWC this season is clear: reduce inventory. And they reported they're on track with that plan.
Were there any segments where revenue actually grew in Q1?
Yes. Parts, accessories, and apparel, what they call P&A, and also their OEM engine business. That combined segment was up 5% to $322 million.
What drove that growth?
Mostly higher volume of snowmobile parts sales, which makes sense given that strong finish to the season. Plus, just ongoing service and maintenance revenue from the growing number of BRP vehicles out there being used.
But accessories were softer.
Yeah, accessory sales specifically were a bit softer, which kind of lines up with the overall retail trends for the vehicles themselves.
Okay, let's really focus on this inventory situation then, because it sounds like it's absolutely central to everything right now. You said network inventory is down. How much?
This is a really critical number. Total network inventory, so products sitting at dealers, was down 21% compared to the same time last year.
21%. That's a big chunk.
It is. And it wasn't just one product line. They saw double-digit declines across all their product lines.
And what does that reduction mean for the dealers financially?
This is key to their strategy. Management highlighted that dealer credit line usage, how much the dealers are borrowing against their inventory, is now just above 70%.
And that's low.
Yeah, it's the lowest level in over 2 years and actually below pre-COVID rates. The goal here is to ease the financial burden on their dealers.
Right, less debt pressure.
Exactly. And it also gives them capacity, basically borrowing room, to ramp up orders quickly when retail demand eventually picks back up.
That sounds like a smart move, positioning the network for a rebound. How much more work do they think they need to do on inventory?
Management seems to feel that the, quote, heavy lifting for right-sizing inventory on the year-round products, particularly off-road vehicles, will be largely done by the end of Q2.
So by the end of this summer.
Right. And the significance of that timing.
What does that mean for the second half of their fiscal year?
Well, their expectation, or hope, is that getting this done by Q2 sets them up to better align their wholesale shipments to dealers with the actual retail sales by dealers in the back half of the year.
Getting supply and demand back in sync.
Precisely. That alignment is crucial for their financial performance. However, they did caution there's still some work left on seasonal products.
Snowmobile still. Even after the good Q1.
Yeah, snowmobile inventory, despite that strong Q1 sell-through, still needs more reduction after those 2 consecutive below-average snow seasons overall. They expect total seasonal inventory to be down about 20% year over year by the end of the full fiscal year 26.
Okay, you mentioned tariffs earlier as a cloud hanging over things. What did they say about the direct financial hit from recent tariff changes? Is it a big deal for BRP?
They describe the impact as manageable, at least so far. The main effects are on their P&A business and some components they source from U.S. suppliers.
What about vehicles?
Their finished vehicles made in Canada and Mexico are mostly okay, remaining largely tariff-free because they comply with the USMCA trade agreement.
So what's the dollar figure they put on it for the year?
Based on how things look right now, they estimate the total gross tariff impact for the full fiscal year 26 will be somewhere between $60 and $70 million.
60 to 70 million. How big is that relative to their business?
They pointed out it's less than 1% of their total revenue, so they feel it should be manageable within their overall finances.
And how are they planning to, offset that cost?
We're working on several fronts, looking at changing suppliers, potentially moving assembly for certain parts, driving more manufacturing efficiencies, and also planning some price increases for their model year 26 products that launch later this year. Interestingly, they also made a point of saying their estimated impact is lower than what some competitors have reported. Part of that is down to their specific assumptions about potential China tariffs and some recent tariff relief they've obtained.
But if the direct cost is manageable, what's the bigger worry with tariffs?
Management was quite clear on this. The biggest risk isn't the direct P&L hit, it's the uncertainty it creates. That uncertainty impacts consumer confidence.
Makes people hesitate on big purchases.
Exactly. It keeps potential buyers sitting on the fence wondering what might happen next, and that affects the entire power sports industry, not just BRP.
Let's look at the financials a bit more closely. Margins were down in Q1 compared to last year, right?
Yes. Gross profit margin was 21.4%. That was down year over year.
What were the main things dragging that down?
They listed a few key factors. Lower production volumes, which means less efficiency in their factories, higher sales programs, those incentives we talked about,
Right.
an unfavorable product mix, maybe selling more lower margin units relative to higher margin ones, and some headwinds from foreign exchange rates.
Were there any offsets?
Yeah, those are partially offset by some ongoing manufacturing efficiencies they're finding and the pricing actions they've taken previously. They also noted that the direct tariff impact on Q1 cost of goods sold was minimal because most of those costs were still sitting in inventory on the balance sheet. They did quantify some specific Q1 margin impacts, though, from mix, sales programs, and fixed cost absorption, basically, spreading fixed factory costs over fewer units produced.
Okay, so Q1 played out as they expected, but clearly showed the pressures from the market and their own inventory actions. What's the outlook now for the rest of the fiscal year?
Well, they said Q1 unfolded pretty much as planned. For Q2, they expect it to be the last quarter where they're doing really significant network inventory reduction.
And financial performance in Q2?
They expect it to look pretty similar to Q1 financially.
Okay. What about the second half of the year, Q3 and Q4? That's where things get interesting, presumably.
That's where the uncertainty really bites. They said visibility for the second half is still difficult, primarily because of that evolving tariff situation and just not knowing how it will impact the economy and consumer spending.
So no formal guidance?
Correct. Because of that uncertainty, they are not issuing formal financial guidance for the full fiscal year 26 at this point.
That lack of guidance really speaks volumes about the uncertainty, doesn't it? But did they sound pessimistic about H2, or was there some optimism?
No, they definitely expressed some optimism based on a couple of key things they expect to happen.
Okay, like what?
First, the big one. Assuming they get that inventory reduction mostly finished by the end of Q2, like the plan.
Right, the heavy lifting done.
Then they expect wholesale shipments to align much better with retail sales in the second half. That alone should significantly improve their financial results compared to the second half of last year, which was heavily weighed down by all the inventory adjustments they were making then.
Makes sense.
Yeah.
What was the second element?
New products. The launch of their model year 26 lineup. These start shipping in August and will ramp up through the second half. They're clearly counting on these new vehicles to stimulate demand and also improve their sales mix and profit margins.
So if the retail environment just stays stable, what could that combination mean for the second half?
They actually put a scenario out there. They suggested that if the retail environment just stays consistent with what they saw in Q1, then these two factors, the inventory alignment and the new product launches, could potentially lead to double-digit top-line growth and a strong improvement in normalized EBITDA and EPS compared to H2 of last year. So the overall message was that they feel well-equipped to handle different scenarios. They pointed to their healthier inventory levels now versus competitors, the strength of the upcoming products, their agile manufacturing setup, and a solid balance sheet.
Okay, beyond the core financials and market stuff, what else came up on the call that caught your ear? Any other notable points?
Yeah, a couple of things. First, a nice recognition for their team, their design and innovation group won the Red Dot Design Team of the Year 2025 award. That's a pretty prestigious global design award.
That's great for them. And there was some big news about leadership, too.
Yes, the CEO, Jose Bohali, announced he plans to retire by the end of this fiscal year. That's after a successor is appointed.
Wow, he's been there a long time, hasn't he?
36 years with the company, 22 of those as CEO. So a major transition. They've started a global search process, expecting it to take maybe 3 to 9 months.
Okay. And any update on the marine business? They sold off most of it, but kept something.
Right. They kept the legacy outboard engine parts business. Apparently, they couldn't get a price they felt was acceptable for it during the main sale process.
Does it be worth keeping?
They described it as pretty low maintenance and profitable. Generated over $70 million in revenue last year with around a 25% EBITDA margin. So it's actually a decent little contributor.
Interesting. Going back to the dealers for a second, what's the vibe from them, according to BRP?
The feedback BRP relayed was that dealers are really focused right now on moving the current model year inventory, the MY25s. BRP feels their dealers are generally in a better spot than some competitors' dealers heading into a potential rebound.
Why is that?
They cited better potential margins for their dealers, the overall BRP dealer value proposition, and crucially, the fact that BRP dealers started with and now have leaner inventory levels, less pressure to deep discount old stock.
You mentioned earlier the shift away from entry-level demand. Did they give any more color on the customer side of things?
Yeah, a bit. They noted the mix of first-time buyers or new entrants is back down to pre-COVID levels, around 21%. And just confirming that trend, demand for premium higher-end products remains stronger than for entry-level.
And financing is a factor there.
Definitely. They specifically said financing is getting tougher for lower-income customers. The lower-tier finance companies are being more selective, especially for lower credit scores.
Which hits entry-level sales harder.
Exactly. It's impacting sales of products like the Riker three-wheeler, which often attracts those buyers. Interestingly, for customers who do get approved, their credit scores and approval rates haven't changed much. It's just getting harder to get approved in the first place if you're in a lower credit tier.
Okay. One last thing. They mentioned a potential U.S. bill about interest write-offs.
Yes, apparently there's a proposed bill in the U.S. that could allow buyers to write off interest paid on loans for U.S.-assembled power sports products.
Would that help BRP?
They're watching it, but said it's very early stages. The potential impact is unclear, depends on details like income caps, how the deduction might work. They kind of framed it as potentially becoming part of broader discussions about subsidies or incentives between countries.
Okay, so pulling this all together now, what's the main story coming out of this BRP call?
I think it's a story of a company really trying to execute methodically in a genuinely difficult market. They seem confident in their internal plan, especially around fixing the inventory problem.
Right, that inventory piece feels like job number one.
Absolutely. They see getting inventory right as the necessary first step before they can really benefit from any market improvement or new product launches.
So the narrative is very much manage through the current softness and uncertainty, control what you can control, which is mainly inventory right now, and get ready for the next phase.
And the progress they reported on lowering dealer inventory, that 21% drop, is presented as a really key positive step. If they nail that Q2 target of getting it largely done,
then H2 could look a lot better financially than last year's H2.
that's the potential upside they're pointing to, yeah. because last year's H2 was all about those painful inventory reduction costs hitting the books.
But, and it's a big but, that lack of formal guidance really hammers home how uncertain the timing of any real consumer rebound is.
Totally. It hinges so much on those bigger economic factors and, how this whole tariff situation unfolds. Nobody really knows.
And even though BRP thinks the direct cost of tariffs is manageable for them,
that indirect effect, the hit to consumer confidence across the board, that's the big unknown for the whole industry.
right, you can manage your costs, but you can't force nervous consumers to spend money.
Yeah. Exactly. So their big bet for the second half, beyond just the inventory cleanup, really rests on those new model year 26 products hitting the mark and providing a real catalyst for demand and better margins.
And then there's the CEO transition happening in the background, another thing for investors to watch, although it sounds planned.
And understanding those nuances in retail, like high-end versus entry-level, current versus non-current models, the financing challenges, that really helps you appreciate how these broader economic pressures are playing out on the ground for different customers and product types.
Okay, let's step away from just summarizing for a second. Time for our "This is not financial advice" segment. Let's put on the speculative hedge fund analyst hats. Based purely on the narrative we just discussed from the call, what's an outrageous but maybe plausible trade idea?
Okay, purely illustrative, definitely not advice. But playing off BRP's story about finishing their destocking faster than others and banking hard on those new MY26 products for an H2 rebound. Here's a thought.
All right, lay it on us.
You could consider going long BRP. The ticker's DOO on the Toronto Stock Exchange, DUUO on the NASDAQ. The thesis. The market might be underappreciating the potential earnings recovery in the second half of this year and into fiscal 27 if BRP pulls off this inventory alignment and if their new products hit home, even in just a stable retail environment.
So you're betting on their execution and product cycle beating the current gloomy outlook. How would you potentially hedge that or structure it as a pair trade?
Well, to maybe balance that long BRP bet, you could simultaneously look at a short position somewhere else. Perhaps shorting a direct power sports competitor who seems much further behind on cleaning up their own inventory, especially if they're stuck with lots of older models needing heavy discounts that will crush their margins for longer.
Okay, shorting a lagging competitor.
Or you could look outside the manufacturers, maybe short a consumer finance company that has significant exposure to subprime borrowers, specifically within the discretionary power sports or RV space.
Why them?
The bet there would be that the continued economic squeeze on lower income consumers, plus that shift away from entry-level products where financing is crucial, leads to worse than expected loan performance, higher delinquencies, weaker loan growth hitting their business harder than the market currently expects.
Interesting. So the potential alpha in this hypothetical trade comes from picking BRP's operational execution and product cycle strength against what you perceive as a weaker competitor or a more exposed part of the financing chain.
That's the idea. But again, completely hypothetical, massive risk involved, absolutely not financial advice, requires deep, deep research.
Understood. So let's wrap this up. The key takeaway from BRP's Q1 call seems to be disciplined execution, getting that inventory down ahead of plan in a really challenging market. They're setting the table for a potentially stronger second half driven by new products if the macro environment cooperates.
Yeah, but that lack of formal guidance is the big flashing light. Uncertainty, especially around consumer behavior and tariffs, is still the name of the game.
And just to reiterate, everything we've discussed here is based solely on BRP's reported results and what their management said on the conference call. It's not an endorsement of anything they said, and it is certainly not financial advice.
Absolutely. Going to the source like this always gives you way more context than just reading headlines.
Definitely. So after hearing this breakdown of the BRP call, what's the one thing that stands out most to you?